It's 9:37 a.m. You open your phone, just a quick check, just to see, and there it is, red, everywhere. Your portfolio's down 5%. Not 0.5%, not some tiny little wiggle you can ignore. 5% in one day, or maybe over the last week. And suddenly your stomach tightens. You start doing math you didn't plan on doing before coffee. Okay, so that's like, what, $2,000? $5,000? $12,000? And then the thoughts come. Should I sell? Is this the start of something bigger? What if this is like 2008? What if this is like 2020? What if I just get out now and wait? And here's the weird part. Nothing about your life changed this morning. Your job is the same, your income is the same, your house didn't shrink overnight, the companies you invested in didn't suddenly stop existing at 9:31 a.m., but your brain is acting like a fire alarm is going off. My name is Tim, and I spend way too much time thinking about money, not just how to make it, but why we react to it the way we do. Why a screen full of red numbers can hijack our mood for the entire day. Why some people build wealth quietly over decades, while others bounce in and out of the market like they're trying to escape a burning building. And here's what I've learned. When stocks drop 5%, most people panic. But that 5% moment, that's actually where long-term wealth is built or destroyed. In this video, I want to walk you through exactly what to do every single time the market drops 5%. Not theory, not hype, not just hold forever, bro. I mean a simple, repeatable mental and practical process you can use over and over again. The kind of thing that changes how you feel in those red screen mornings. Because if you can train yourself to respond differently to a 5% drop, you're not just managing money better, you're managing yourself better. And honestly, that's the real game.
I know, that sounds boring, but it's the most important thing. When stocks drop 5%, your brain treats it like danger. Not metaphorical danger, real danger. The same part of your brain that evolved to help you run from predators is now staring at a candlestick chart. And that part of your brain does not care about long-term compounding. It cares about survival. There's actually a name for this in behavioral finance, loss aversion. People feel losses roughly twice as intensely as gains. So if your portfolio goes up $10,000, you're like, nice. If it goes down $10,000, it feels like a punch. Back in March 2020, when the pandemic hit and markets dropped at record speed, people panicked. The S&P 500 fell more than 30% in just weeks. Entire retirement accounts were bleeding red. I remember refreshing my brokerage app like it was going to apologize and say, just kidding. It didn't. And I remember thinking, should I reduce exposure? Just temporarily? Just until things calm down? If I had sold out of fear, I would have missed one of the fastest recoveries in market history. So here's rule number 1 when you see that 5% drop. Do nothing for 24 hours. Close the app, put the phone down. Go for a walk. Literally touch grass. Why does this matter? Because decisions made in emotional spikes are almost always bad ones. You don't need to be a monk. You don't need to feel zen. You just need a buffer, a cooling off period. Actionable takeaway? Create a personal rule. I never make investment decisions on the same day as a sharp drop. Write it down, commit to it. It sounds simple. It is simple, and it will save you thousands. After your 24-hour pause, open the chart again. But here's the trick. Don't look at the one-day chart. Zoom out. 1 year, 5 years, 10 years, max. When you zoom out on something like the S&P 500 over decades, those terrifying 5% drops, they barely register. They're tiny little dents in a long upward climb. Think about the 2008 financial crisis. At the time, it felt like the financial system might collapse. Banks were failing. Headlines were apocalyptic. The market dropped more than 50% from peak to trough. But if you look at a long-term chart today, it's a dip. A serious dip, yes, but a dip in a larger growth story. Same with the COVID crash of 2020. Same with countless corrections before that. Markets don't move in straight lines. They move in jagged, uncomfortable, emotionally annoying waves. If you only look at daily moves, investing feels chaotic. If you look at decades, it feels almost predictable. Here's the simple breakdown. Short term equals noise. Long term equals trend. Why does this matter? Because wealth is built on trends, not noise. When you panic at 5%, you're reacting to noise as if it's the end of the trend. Actionable takeaway? Every time you see a drop, force yourself to look at a 10-year chart before doing anything else. Make that your ritual. It rewires your perception.
After you've paused and zoomed out, ask yourself this: has the reason I invested actually changed? Not the price, the reason. If you own broad index funds tracking something like the S&P 500, your thesis is probably something like, over decades, American businesses grow, innovate, and increase profits. Did that thesis collapse because of a 5% drop? Probably not. If you own individual companies, ask, has the company's long-term outlook fundamentally changed, or is the price just moving because of fear, headlines, or short-term earnings noise? Most of the time, a 5% drop says more about market sentiment than business reality. But here's where I'll be honest. Sometimes the reason does change. Sometimes you bought something speculative, something you didn't fully understand, something you purchased because it was trending or because someone on the internet sounded confident. And when it drops 5%, you realize you never really had conviction to begin with. That's not a market problem. That's a clarity problem. Why this matters? If your investment thesis is solid, volatility is a feature, not a bug. If your thesis was weak, volatility exposes it. Actionable takeaway? Write down in one sentence why you own each major investment. If you can't explain it simply, you probably shouldn't own it. That exercise alone can transform how you react during drops. Now we get practical. When stocks drop 5%, most people think in extremes. Sell everything, buy everything, do something dramatic. But long-term investors think differently. They think in percentages. Let's say your target allocation is 80% stocks, 20% bonds. After a drop, maybe you're now 75% stocks and 25% bonds. That's not a crisis. That's an opportunity to rebalance. Rebalancing means selling a little of what's held up better and buying a little of what's fallen to get back to your original plan. It feels counterintuitive. You're buying what just dropped, but that's literally the definition of buying low. After major declines during events like the 2008 financial crisis, disciplined rebalancing forced investors to buy stocks when they were deeply discounted. And over time, that discipline paid off. Here's the simple breakdown. Reacting means changing your strategy because of fear. Rebalancing means executing your existing strategy because of math. Why this matters? Because it turns volatility into a mechanical process instead of an emotional one. Actionable takeaway? Set predefined rebalancing rules. For example, rebalance once per year, or rebalance when allocations drift more than 5%. Make it rules-based, not feelings-based. This one is powerful. When markets drop 5%, headlines scream, social media panics, financial news anchors look concerned in HD, and your instinct might be to wait. I'll invest when things feel safer. But here's the twist. The market often feels safest near peaks and most terrifying near bottoms. During the 2020 crash, investing felt reckless, but that period ended up being one of the best buying opportunities in recent history. So what do? You automate. Set up automatic contributions to your retirement accounts. Every paycheck, no matter what the market is doing. That's called dollar cost averaging. It means you buy more shares when prices are low and fewer when prices are high, automatically. You remove yourself from the decision. Why does this matter? Because your biggest enemy in investing is not the market, it's hesitation. Actionable takeaway? If you're not already, set up automatic investments. Treat it like a bill, Non-negotiable. Let the system work while your emotions do their thing.
Let's be real for a second. If a 5% drop makes you panic, it might not be a strategy problem. It might be a risk tolerance mismatch. You can tell yourself you're aggressive. You can say you're in it for the long term. But if every dip ruins your week, your portfolio might be too volatile for your psychology. And that's okay. Investing is not about maximizing theoretical returns. It's about maximizing the return you can actually stick with. Some people can handle 100% stocks. Others sleep better at 70-30 or 60-30. There is no moral superiority in being all in. Why this matters? The best portfolio is the one you won't abandon during a storm. Actionable takeaway? If a 5% drop feels catastrophic, consider adjusting your allocations slightly, not dramatically, just enough to help you stay consistent. Small tweaks can create big psychological relief. Here's something most people don't think about. Volatility creates opportunity, especially for disciplined investors. When retail investors panic sell during downturns, who's buying? Often large institutions, funds with long time horizons, investors with strict rules and deep pockets. They're not emotional, they're strategic. When you sell out of fear during a routine correction, you're often transferring future gains to someone more patient. That stings a little, right? It should. Why this matters? Every time you panic, someone calmer benefits. Actionable takeaway? The next time you feel the urge to sell during a 5% drop, imagine a calm, methodical investor on the other side of your trade. Do you want to be the panicker or the patient one? Choose your role. This is the perspective shift. Instead of seeing a 5% drop as a threat, see it as practice. Because bigger drops will come. That's not pessimism, that's history. The S&P 500 has experienced countless corrections over decades. It has survived wars, recessions, political chaos, pandemics, inflation scares, tech bubbles, and yet the long-term trajectory has been upward. If you can't handle 5%, how will you handle 15% or 25%? These smaller dips are like emotional weightlifting. They build your tolerance. I used to obsessively check my portfolio during every downturn. Refresh, refresh, refresh. Now, I still notice, I'm human, but it doesn't control me the same way, because I've seen this movie before. Actionable takeaway? When the market drops, instead of asking, how do I escape this? Ask, how do I train through this? That subtle shift builds resilience. This might be the most important mindset shift of all. Most people think safety means no volatility, but that's not real safety. Real financial risk isn't a 5% drop. It's not investing at all, constantly buying high and selling low, letting fear interrupt compounding for decades. Cash feels safe because the number doesn't move, but inflation quietly erodes it, slowly, invisibly. Volatility is loud, inflation is silent. One feels scary, the other is dangerous. Why this matters? If you redefine safety as stability of strategy instead of stability of price, everything changes. Actionable takeaway? Focus less on daily price swings and more on whether your plan is consistent, diversified, and long-term. Price stability is comforting. Strategy stability builds wealth. Let's bring this back to that 9:37 a.m. moment. You open your phone, you see red, you feel that tightening in your chest. Here's what you do. You pause for 24 hours. You zoom out. You check your thesis. You rebalance if needed. You keep investing automatically. You adjust risk only if it truly doesn't fit you. You remind yourself that someone else is waiting for you to panic, and you treat the drop as training. That's it. No drama, no heroic moves, no frantic selling. Just calm, repeatable discipline. Because here's the quiet truth about building wealth. It's not about predicting crashes. It's not about perfectly timing bottoms. It's not about being smarter than everyone else. It's about managing your behavior when things get uncomfortable. A 5% drop is not the end of your plan. It's a test of it. And honestly, if you can pass the 5% test over and over again, year after year, you're going to be just fine.
So the next time your screen turns red, don't ask, what should I do to escape this? Ask, what would the future version of me, the calm, wealthy, patient version do right now? Then do that. Quietly. Consistently.
And here's the part nobody really talks about. Every 5% drop is shaping your identity. Not your portfolio, your identity. Are you the kind of investor who reacts to noise or the kind who moves with intention? Because wealth over the long run is less about intelligence and more about repetition. It's about proving to yourself again and again that you can stay steady when things wobble. There's something strangely empowering about watching the market dip and thinking, oh, this again. Not in a dismissive way, not arrogantly, just calmly, like someone who's driven through rain before. You don't slam the brakes every time a drop hits the windshield. You adjust. You keep going. You trust the road. And honestly, a 5% drop is normal. It doesn't feel normal, I know, but historically, it's just part of the rhythm. Markets breathe in and out. They surge, they pull back, they test patience. If every small decline knocks you off course, the market will feel chaotic forever. But once you accept that volatility is the price of admission, it starts to feel less personal. Because that's what it feels like sometimes, right? Personal, like the market is targeting your account specifically, as if the second you invest, it decides to dip just to mess with you. But markets don't know you exist. They don't care about your entry price. They're just millions of decisions colliding in real time. Removing that sense of personalization helps more than you'd think. And here's a quiet reminder. Long-term investing is supposed to be boring most of the time. If it constantly feels dramatic, urgent, adrenaline-filled, you're probably interacting with it too much. The real magic happens slowly, quietly, almost invisibly. Compounding doesn't scream, it whispers. So the next time you see that 5% drop, take a breath, notice the feeling. Don't judge it, just observe it. Then walk yourself through the process. Pause, zoom out, reassess, continue. You don't need to be fearless, you just need to be consistent. And years from now, when you look back at old charts and see dozens of tiny dips that once felt enormous, you'll barely remember the anxiety. What you will see is a long upward climb and the quiet discipline that carried you there. That's how you win.